Welcome to the pulse of the market and beyond. Hongkongers are flocking across the border to Shenzhen in record numbers, drawn by the massive, stylish, and budget-friendly appeal of new cultural landmarks like the Shenzhen Bay Culture Square. Just like Dominique Lee and his wife, travelers are finding that these modern spaces offer more choices and a fresher vibe than traditional districts, forcing Hong Kong to rethink its strategy to stay competitive.
Never run out of battery again with the INIU portable charger, the slimmest 10,000 mAh power bank that keeps your devices charged on the go. Stay powered up wherever you go. Click the link in the video description to shop now on Amazon.
Next, the financial world is buzzing over the ChiNext board on the Shenzhen Stock Exchange. Following a major package of regulatory reforms, this hub for innovative startups is hitting all-time highs as investor sentiment surges. With market leaders like contemporary Amperex Technology Limited leading the charge, analysts like Su Kai from Zhongtai Securities believe this re-rating of growth stocks is only just beginning. In a strategic move within the materials sector, Shenzhen Woer Heat-shrinkable Material has officially announced it is considering a significant transfer regarding the listing of Shanghai Keter New Material. This potential shift is already drawing eyes from industry observers tracking portfolio adjustments. Finally, the markets are feeling the pressure as the three major A-share indices opened lower this morning, with China Telecom taking a hit after its latest profit report. From the decline of YOFC to the surge in profit for Shannon Xinchuang, there is massive movement across the board today. Stay on top of these trends by hitting that like button, subscribing to our channel, and ringing the bell for all the latest updates. Ever feel like your weekend in Hong Kong is just one big game of sardines? Well, you're not alone, and it turns out the locals have found the ultimate escape hatch right across the border. Forget the long-haul flights. Shenzhen has quietly transformed into the ultimate weekend hotspot for Hong Kongers craving a little more room to breathe. Take Dominique Lee, for instance, an engineer from Tin Shui Wai who recently ditched the local crowds for a 2-day stint in Shenzhen. For him, the trek to the Nanshan district's new Shenzhen Bay Culture Square takes about the same amount of time as a trek to Causeway Bay, but the experience, it's a completely different league. We're talking sprawling plazas, high-end design, and that rare luxury of finding a cafe where you aren't elbow to elbow with 100 other people. It's not just about saving money, though the price point definitely doesn't hurt. It's about the sheer variety and that addictive feeling that the city is constantly evolving. But here is the million-dollar question. If Shenzhen keeps raising the bar, what happens to Hong Kong? Experts are sounding the alarm, suggesting that unless Hong Kong leans hard into its unique international flair and world-class events, it might just keep losing its own residents to the neighbor across the river. It's a wake-up call for the city that never sleeps to start reinventing itself. Have you made the trek across the border yet, or are you holding out for a change in Hong Kong's own cultural scene? Hit that like button if you felt the urge to jump the border lately. And remember, sometimes the best way to appreciate your own backyard is to see what everyone else is doing in theirs. Ever wondered why investors are suddenly flocking to Shenzhen's tech hub like it's the next gold rush? Forget the old school market giants for a second, because the ChiNext board, often called China's Nasdaq, is absolutely catching fire. After a major overhaul of listing and trading rules hit the scene earlier this month, investor sentiment hasn't just ticked up, it's ignited. We're talking about an all-time high for this 16-year-old board, and frankly, the market is eating it up. Here is why this matters. The ChiNext 50 index and the composite index just blew past their 2015 peaks, leaving other yuan-denominated stocks in the dust. While the rest of the market is still catching its breath from global geopolitical headwinds, ChiNext is sprinting. Analysts like Su Kai from Zhongtai Securities are calling this a classic valuation re-rating. Essentially, the reforms have shifted how we view risk, turning what was once a volatile space into a magnet for high-quality, innovative growth stocks. Let's look at the numbers. What started in 2009 with a modest 28 companies has exploded into a beast of 1,396 listings, commanding a staggering 20.3 trillion yuan. That's nearly half of the entire Shenzhen exchange's market cap. And who is driving this bus? The heavy hitters are massive players like CATL, the global king of lithium batteries, alongside AI data center giants like Zhangji in Nolite and Eoptolink. These three titans alone make up nearly half the weighting of the ChiNext 50. While China's benchmark CSI 300 is plodding along with a 3.4% gain, the ChiNext gauge is up a blistering 18% this year. It's clear that renewable energy and AI are no longer just buzzwords. They are the engines powering this record-breaking run. So, is this just a speculative bubble, or are we witnessing a fundamental shift in where the smart money resides? Hit that subscribe button and let me know your take in the comments below. After all, in the world of high-growth tech, the only thing more dangerous than staying on the sidelines is missing the next big leap. Ever wonder what happens behind the scenes when a major player decides to shake up its corporate structure? Well, news just dropped that has the investment world buzzing. Shenzhen Woer Heat-shrinkable Material has officially announced they are weighing the pros and cons of transferring the listing of their subsidiary, Shanghai Keter New Material. Now, why does this matter? It is a classic strategic move. When a company looks at spinning off or relisting a division like Keter, they are usually hunting for better valuation, deeper capital access, or just a cleaner focus for their core business. It is a bold play that signals they are ready to unlock some serious value in the materials market. Keep a close eye on this one, because shifts like these often ripple across the entire sector. If you want to keep up with the latest moves shaping global industry, hit that subscribe button and ring the bell so you don't miss our deep dive on what this could mean for shareholders. After all, in the world of high-stakes business, the biggest shifts often happen in the fine print. Is the Chinese market bracing for a correction, or is this just a classic morning shakeout? The A-share indices kicked off the session in the red today, with the Shanghai Composite, Shenzhen Component, and ChiNext all sliding between 0.3 and 1%. It is a cautious start, and when you look at the macro picture, it is easy to see why. The People's Bank of China just injected 4.5 billion RMB into the system through reverse repos, yet the RMB's central parity against the dollar softened slightly. It is a delicate balancing act of liquidity in a market that is clearly still searching for direction. Looking at the movers, the narrative is split right down the middle. On one hand, you have China Telecom dragging the sector down with a nearly 2% drop following a double-digit slide in first quarter net profit. Meanwhile, the chip sector remains under pressure. SMIC, Hua Hong, and Cambricon all opened in the red, signaling that investors are still hesitant about the tech landscape. But don't look away just yet, because there are some wild outliers. Take Shannon Xinchuang, for example. Their profits surged over 78 times year-over-year. That is the kind of explosive growth that makes you wonder if we are overlooking hidden gems in this sea of red. Then there is the bizarre case of Eoptolink. They posted a massive profit jump of over 76%, yet the stock dropped 9% at the open. It is a textbook reminder that in today's market, the buy the rumor, sell the news mentality is alive and well. As we watch how these stocks digest their earnings reports, one thing is clear. Sentiment is currently dictated more by the fear of downside than the promise of performance. Are you keeping an eye on these tech earnings, or are you sitting on the sidelines until the volatility settles? Drop your thoughts in the comments below, and don't forget to subscribe for more deep dives into the global markets. Remember, in a market this unpredictable, patience is often the greatest asset you have.